Today, we're breaking down how soft credit checks affect the home buying process because lenders do soft credit checks up until the day of closing. And the reason I'm making this video is we just had this happen to a client, which affected them, right? So why is this such a big deal and how does it affect you? Because you can disqualify yourself or delay closing on a mortgage, costing you more money to buy a house, like extending a lock or paying per diem to a seller for delaying a closing. So today we're going to go over what a lender is looking for and what you can do to mitigate some of these issues from happening. Look, guys, it's already hard to purchase a property, get under contract. You're already looking. And you just don't want to be able to get into those like small issues that come up for no reason. So first, let's look at what happens when you get pre-approved, which this lays the foundation for that soft credit inquiry. The first thing I'm going to talk about is you definitely need to have a hard credit inquiry. Soft credit checks don't allow you to what's called run an automated underwriting system. You can't do it without it. So it's a good idea to have it done because it pulls all the real data. Now, a credit report is good for 90 days, and you do have a 45-day window to have your credit looked at unlimited times by lenders, and it won't affect your credit score. This is in the CFPB, the Consumer Financial Protection Bureau. It's listed right in there. You have a 45-day window. So now with that being said, technically you're pre-approved for 90 days from the time that credit has been looked at, right? And the lender's giving you that pre-approval. But a lot can change within those 90 days, right? Especially if your financial picture changes, you definitely need to talk to a lender. We have people that are coming from overseas and they're using that beautiful VA home loan, and then all of a sudden they're like, hey, I need to purchase a car. Either I'm financing it or I'm paying it in cash. Well, that has different implications on the mortgage itself, and we run into both without people talking to us, and then it's just a scram to get everything finished. Now, the same thing applies if you're changing jobs. Make sure you're talking with a lender because sometimes it's okay and sometimes it's not okay. It just really depends on the type of job, and we got plenty of videos on the channel talking about that. So, and this also is important to understand, is if you're closing within that 90-day mark of your credit check, it's going to depend on when your closing is going to be, because a lender may require, or actually they're going to require for sure a new credit report if it's more than 90 days out. So you have to be careful of that, and I would say extremely mindful because you want to be able to pull that credit sooner than later because it has an effect on a lot of different things. So an example would be, let's say April 20th is your closing, but your credit expires April 10th, right? You would want to be looking like 30, 60, 90 days or 60 days out from that to look at the credit. Now, there gets to be some advantages to waiting, because if your credit goes down, you're going to have a higher interest rate. Now, if your credit goes up, which is what we want, it benefits you because lenders can then give you a better interest rate. Now, the cool part is that lenders, well, actually, this could be also a bad thing, right? So it just kind of depends. When lenders lock an interest rate in, so let's say I lock the rate today for 45 days. And within that 45 days, let's say your credit jumps up and we take a look at a new credit report. Now, this is going to be based on a new credit report, not doing a soft credit check. So based on a new credit report, then the lender can actually give you a better rate based on the days lock when you originally locked the loan. Now, some lenders give you the flexibility to do a float down. So there's a lot of different options that you have within that. Now, another thing that lenders are going to be looking for is, are you overutilizing your current debt, potentially disqualifying yourself or taking on new debt, like taking out a car loan, or there's times when clients get collections added to their account or they've missed payments, right? All of that is going to affect how the home buying process is going to be for you. Now, lenders also ask for a letter of explanation for any credit inquiries you have. Now, listen, do not try to lie to a lender and let them know that you didn't buy a car when there's a credit inquiry, and now we're being notified by the credit company that you have a liability in your credit report. It's just not a good way to go into a transaction. And I think a lot of people hurt themselves by doing that. We've only had that happen a handful of times, right? So lenders will pull this soft pull, okay, within a 15-day period of closing. And like I mentioned earlier, up into the day of closing when either a loan is clear to close, meaning that you're good to go to purchase the property, or it can be when the title docs are being drawn or the title figures are being drawn for the title company, which that's where the issues start really popping up because of that miscommunication with the lender. Now, if the lender already knows it, then they're going to be fine with it because they've already documented all of that. And that's why that financial picture changing is going to have a delay, because now a lender needs to step back and then verify all of that debt to be then reported on a credit report. That's why it's just so urgent to do that, right? Lender's going to see, are you over leveraging your debt? How does your new credit card payments affect your mortgage? How does like a car payment going to affect it? And one thing that people will, I'm happy that they called, like, hey, David, we need to buy furniture for the house. We're at the store. They got a great interest rate, 0% interest rate on the furniture through this weekend. No. If you're within a very tight time frame for closing, I would hold off on any type of big purchases. Again, unless your financial picture allows for it, which is just going to be a toss-up based on your individual financial picture. Now remember, VA loans don't necessarily look at debt-to-income ratios, but it is a part of it. They look at residual income. But I don't even know how to explain it. Through our automated underwriting system, even like a small additional debt could take a very easy, doable loan into not doable. That's why you have two parts to every VA loan, right? Qualification and eligibility. Most of you watching are going to be eligible to use the VA loan. Not everyone's going to be qualified, but you all could get to that position at some point, right? Working on your credit, making sure that you have income, and you're saving up money, because there's still going to be closing costs involved with purchasing a property, which again, we have a ton of videos around that. Now, also just keep in the back of your mind assets, right? Money for down payment. If you're moving money around, lenders are going to need to verify all of that, all the transfers, and make sure that you're sending money from an account to the title company, or a check when you go to closing from an account that they have verified, because otherwise, once again, it kind of goes back into that underwriting process, which delays the closing. Hope you guys learned some stuff today. Smash that like and subscribe button, and I'll catch you guys soon.